What's up, everybody? It's Chris again. Today we are going to be looking at a few things that I think are generally overlooked in options trading and I think are very important to just remind yourself of regardless of what level you're at. So the first thing I want to go over is the break-even price and expiration. We need to remember that option contracts are not just priced, and they don't just follow the stock. I mean, they're made up of many different factors, one of them obviously being the price of the underlying stock. But I get asked a lot of times, Chris, the stock is going up, but my option's not moving. I mean, you clearly don't have a very deep understanding of how these option contracts are priced if you're confused by that. So that's why I'm making this video, because I want to help you. So one, why that's probably happening is because you are either too far out of the money. That could be it. If it really is a big move up and your option contracts aren't changing. I mean, also you could, if the price is going up and you have puts, I hope you can already understand that, but if you have puts and the price is going up, that's going to hurt you. But the price can be going up, and it can be going up pretty fast, but say you pick an option that is super far out of the money, which means the stock has to go a larger percent move to get to that strike price that you chose, either on the call side or the put side. There, one is a lower likelihood of that happening, a lower likelihood of that option contract becoming in the money or even close. And so, say a stock is at $100 and you buy a strike price for $200. So you're betting on the stock to double its entire value. I mean, depending on how far out you have, yes, that might not be a horrible idea, and you can make money, but you need to understand how the time affects these contracts and how theta does. I want to just pull this up to show you. So you can see here's a NVIDIA, what is this, a August 7th, I think this is a 465 call. And so here's NVIDIA on the side. So on 7/28, we can see right here that for most of the day, we pretty much just chopped up and down. We didn't really do much. We didn't really move anywhere. I mean, we came down pretty hard in the morning, which you can see on this is the price of that option contract, the 465 call, which is pretty far out of the money, but again, NVIDIA is a pretty big mover, and with earnings coming up and implied volatility, these contracts are a little bit juiced up. But so you see that big move down here in the morning and the big move down on the option price, and so basically it's following it there, but then for the rest of the day, I mean, you get this solid move up, and you're really just going sideways. You don't really have another solid move down here, but the option price, I mean, it opened at 1.1, or that was on 27. So, I mean, it got all the way down to 0.6 at the very end of the day, but you can see even on this move up and on this all in this chop here, you're just losing value in your option contract because of theta. So, like, for example, right here, you're getting these green candles in this move up, but like I said, this contract is farther out of the money, and that move up doesn't really matter for option contracts. You need to understand, one, that you need big moves, especially with these far out of the money contracts, to make you money, and two, that if it's not moving fast, or if it's not moving with volume, or if you're getting plastered by theta because your contract is expiring in a couple days, you still could be losing money on that option. So it's important to check that out and look at it. And I mean, you can see when we zoom out, we had a big move up that night from 408, and it looks like we opened around, can't really see, it looks like we opened around 415, $7 move up. So we get that big jump in the option price, in the price of the option contract. But then again, I mean, we don't really get much movement here. I mean, a little bit. You can capitalize on this and make some small gains on these little contracts, but even in this pretty decent move up, I mean, what did we open at? 414, close around like 419. The option price really wasn't moving at all. It was just going up and down and up and down and up and down. And then when we zoom out, we see this big move right here, this big and fast move up, and you can see there's a lot of volume. We came up fast. That's where you get the big spikes in the option contracts. I mean, the reason for that is, the way I like to think about it is, say you have 7 days for a stock to move 7% to get in the money. If that stock moves 3.5%, or let's just do 10 to make it easy. So let's say you have 10 trading days for a stock to move 10% to get in the money. If that stock moves 5% on the first day, now you have whatever's left of that first day, and then the 9 other days, so 90% of the time value still left in your contract, yet you only have to move 50% of the initial percent move that you paid for in the contract premium. That's why when these contracts when the stocks are moving very fast and moving with volume up quickly, that's why these option contracts are zooming up, because you're eating away at that percent move. And especially on the ones where you have a lot of time, if you have these giant gap ups, you gap up 10, 15%, and that's how I think about it. Like I just said, I need to move 30% to get in the money, or 20% to get in the money. If I can cut off half of that in a tenth of the entire time on my contract, that's when I look, okay, now might be a good time to sell, because these option contracts might be pretty overpriced. And so you can see that as it kept going, we shot up in the morning, and these contracts got all the way up to $1.58, and then they shot back down, and this is much lower. This is around the 417, and where was here, like 424, so $7 lower. And you can see these option contracts just kind of get killed all the way down, because we have this big move up here and then down, a little bit of chop, and we are negative on the day, I think, or maybe just closed positive. But like I said, you really need these huge moves, and you can see, I mean, look at that option contract. We ripped all the way up to $234, and so you could have caught that, I mean, same day you could have got it at $85, and that's right around the price that you could have gotten it on 7/29, even though even though the price was $20 less than it is here. I mean, that's a perfect example of something that you need to understand in these option contracts, is like, if you bought this contract here, yeah, you can capitalize on the move here, but you can wait. You can wait and let the time crush all of that, watch this move up, confirm your trend, see this heavy momentum with volume, get in at 0.8 where these people got in here, and catch a quick scalp from $80 all the way up to $234. I mean, that's something that people just don't understand about these option contracts and why these certain types of fast and heavy volume moves make everybody the money. Let's get back to the sheet. So the chances of most contracts expiring in the money is low, which makes sense. So obviously we're capitalizing on these contracts most of the time before expiration. I mean, you can play 0 day to expiration. The closer you are to expiration, they're more volatile, but again, theta is affecting you super hard because instead of having days on your contract, you have hours, minutes, and seconds. So that is something that you need to understand, especially when you're playing 0 day to expiration. I mean, that's another one where it's like if the stock's only going up a couple cents, not a big move depending on what it is, you're not really going to make any money. You need a big fat green candle with a lot of volume. The way I like to think about that again is just a buyer versus seller. It's a little bit different when you're scalping because you just buy this contract and sell it, but if you're buying and holding to close to expiration, you have to understand that you're buying it from someone. Someone is willing to sell it to you at that price, and like it says, the chances of most contracts expiring in the money are low, and that makes sense because they wouldn't issue these contracts and they wouldn't sell it to you with these incredible potential returns if they didn't think they had a good chance of winning. And so that's where people capitalize on selling premium, or some people, it's like Theta Gang, they capitalize on Theta by selling premium when implied volatility is very high, and then these contracts expire worthless, and the people that sold the premium and collected the credit initially end up keeping it, and they make the money, and the buyers of the contracts who held on to it to expiration, they end up losing. That is a little bit different than what we do in slab stocks, but again, that's something that I think is very important to understand. The goal inevitably is to buy an option, have it get in the money, and have it stay there. Once the option gets in the money, you have that intrinsic value of it. It has legitimate value being in the money. If it's $1 in the money, you have to remember that you have leverage of 100 contracts. $1 in the money that has at least $100 of worth, and then add in implied volatility and however much time you have left on that for it to continue to move up. That's when you can really get a feel for where your contracts pricings are, when you might potentially want to sell, and when contracts are at a good price to buy. That's something that I'm going to make in a different video, is talking about how to look at the option chain and see how much they are pricing in, which basically means the expected move. You can see, let's go. So right here, this it's market makers something. So that's their expected move. You can also see it right here, and it changes depending on the date of expiration, which is nice. Thinkorswim actually shows you that. But I will make a different video, as you can actually tell from in here, and how much these contracts are worth based off of what I was just saying, how much they're in their money. If they are $1 in the money, we know that at least $100 of that contract is just legitimate worth, because if you're $1 in the money and you can buy a stock for $1 less than it currently is, 100 shares of it, and sell it back for $1 higher, that's worth $100. There's no doubt about it. That is just a fact. And so, again, that's just something that I think is important to remember. Lastly, I think most people trade, or this isn't, and I know, most people trade options with less. I put 20% because I know a lot of people in this group trade with a lot, but most people trade with less than 20%, 10% of their entire investment portfolio in options. Options are super volatile. I say this all the time. It's a derivative that is designed to go to zero at expiration. The odds are against you, and again, we're not playing these contracts all the way to expiration all the time. We're capitalizing on these moves, depending on when that is in reference to the expiration date. It doesn't really matter, but you need to be aware of this when you're looking for low-priced options and looking to find those big moves. So I hope this video was helpful. I'd really appreciate it if you could like and subscribe. I'm trying to put out a lot more content to help you guys and everyone on YouTube who is watching. But that is it for today. I will see you guys soon, and as always, you can message me or DM me with any questions, and have a good one.